Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back Michael Howell for Teaching Bitcoin Part 3. Michael, thanks for joining us once again.
Great pleasure, Nick. Looking forward to it once again.
So today our goal is to discuss Bitcoin's limited supply and explain exactly why Bitcoin is limited to 21 million coins. Michael, I'm curious your thoughts after the first two parts of Teaching Bitcoin, some of the introduction of cryptography. What are your thoughts?
Well, I think the two. I suppose the two thoughts are: one is that we kind of know that Bitcoin, by its evolution, is a decent monetary inflation hedge. But I think the other question, which I think you've answered pretty well, and you're increasingly drilling down into this, is to what extent is Bitcoin, does it have integrity, and is it a sort of safe asset for people to hold? And I think that's really the question that we're kind of tackling right now.
Wonderful. Yes. The integrity of Bitcoin, it's a great way to state the goal of somebody who's a financial researcher looking to understand this asset class. What is the integrity of the asset class? How does it compare to other things that are competing with it? So in that spirit, let's go back to our slide deck here. I want to discuss, we got to the difficulty target in the Bitcoin mining mechanics process. I wanted to introduce you that so that you could absorb the cryptographic process of Bitcoin mining. But now let's go back a little bit to pre-Bitcoin so that we can continue to drill down into why Bitcoin is special and unique and a one of a kind. I think that's also very important here. Bitcoin is a one of a kind in that it should last for a century plus, and it will outlast everything else that is competing with it. So that's my going thesis here. I want to start with Adam Back, who wrote a paper and designed a software, hash-based proof of work. Now, we talked about what the word hash means. It's a function. It's a mathematical function. And the word work here describes performing that function over and over. So Adam Back designed a system called Hashcash, which was designed to discourage spam. And the way that it was designed to discourage spam is that to send an email to a Hashcash user, the sender would have to find a hash of the email that fell within a certain range. And since the range is large, right? We talked about the potential range of the output. Since the range is so large, finding an output within a specific range would then be difficult. And so in that way, it would take many guesses, and this system imposes a cost on sending email. So in that way, it can prevent spam. Because to send me an email, you actually have to find a hash within a certain range, which will take you what? Computational power and time. And theoretically money, because your computer performing hashes theoretically has an electricity cost to it. Not even theoretically, it does. But I say theoretical in that to prevent spam, back in 2002, when this paper came out, that would have been a minimal cost, but non-zero. Now for Bitcoin, the cost to win a block is quite large, right? As the reward is also quite large, we can expect the cost to be quite large as the competition is now fierce, making it very difficult to accomplish the task of mining a Bitcoin block. The Bitcoin Layer is proud to be sponsored by Unchained, the leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults where you hold 2 of 3 keys and benefit from a Bitcoin security partner. This is a really important feature. You can purchase Bitcoin directly into your cold storage with Unchained's trading desk and completely eliminate your exchange risks. Unchained also offers the best IRA product in the industry. You can convert easily your 401k or IRA into Bitcoin while keeping control of your keys. Don't pay more in taxes than you have to. Go talk to them today, unchained.com/TBL, and make sure you use code TBL for $99 off when you create an account. Imagine losing your Bitcoin fortune to a house fire or to accidental damage. A complete nightmare, right? It's estimated that over 30% of Bitcoin are lost forever, and poor seed phrase security is a big reason why. That is why we use Stamp Seed, a really cool DIY kit that allows you to stamp your seed into these titanium plates. So let me show you how it works. They send you a titanium plate. Part of the kit comes with this really easy to use tracker. You slide your seed phrase into the tracker. Now you take the letters that they send you, you take a letter out, and you place it into your device, and then you take this incredibly heavy duty titanium hammer and you hammer your letters into this titanium plate. Your full seed phrase will be stamped into this titanium plate that is fireproof, accident-proof, damage-proof. These tools have been specifically designed by people working in titanium stamping for over 14 years. So go check them out today, stampseed.com, and make sure you use code TBL for 15% off of your order. So the predecessor, Michael, to Bitcoin mining, in many ways, is this hash-based proof-of-work idea called Hashcash from Dr. Adam Back, a cryptographer who's heavily involved in Bitcoin today and also was involved in a decade plus of pre-Bitcoin design ideas.
Does anyone have any notion of the cost of Bitcoin mining?
Yes. So Bitcoin mining, the cost is directly related to two variables. One of those variables is the going difficulty. So we talked about, that's why I showed you that target, so that you can see that that target is moving up and down, because you asked the question in part 2, well, what is the speed of mining or the competition of mining due to the supply? Well, the supply is regulated by this difficulty adjustment every 2 weeks to make sure that blocks come every 10 minutes and we stay on schedule. On average, right? Because it's still it's a guessing game, it's a chance game. Bitcoin mining is a chance game. And so because it's a chance game, you can never get exactly 10 minutes apart in finding blocks. That is actually impossible because it's statistically improbable. But what is probable is that you'll vary on average from 10 minutes in any given period of time, on average. And that variance from 10 minutes is corrected by the algorithm automatically every 2,000 plus blocks, which is about 2 weeks in our human time. And that rule that is inside the protocol existed from the beginning, has never been tampered with, and is never the subject of any BIP, which stands for Bitcoin Improvement Proposal. We talked about the people that are working on improvements to the code, right? Those improvements never include, hey, let's adjust the 21 million supply, let's adjust the halving schedule, let's adjust the difficulty adjustment rules. Those rules are, again, this is now in theory, they're untouchable. And the reason they're untouchable is because they would directly affect the consensus that this is the network and asset that we've chosen. So another thing, Michael, you're wondering is what makes Bitcoin special? What makes it unique? And I explained to you that it's math, it's cryptography, it's a language that people can understand. And that language is now spoken in essentially every country around the world, to the point where I don't have to explain to people in South America, Africa, and Asia, not on my continent, but on other continents. I don't have to explain to them what Bitcoin is. They all understand, and the network effect is there.
Okay, so all these rules that apply to the supply of Bitcoin, they are, I mean, they're not obviously not written up somewhere, but they're accepted by the community. So, what happens if, for example, those rules were changed?
Yes,
Could they be changed?
so they are written up. It's just that they're written up in the Bitcoin code. So
Right.
remember that we have Bitcoin nodes. A Bitcoin node is a computing device that runs an implementation of this Bitcoin protocol. And remember, a protocol, the word protocol is a set of rules.
Mm-hmm.
And so the rules of the Bitcoin protocol are in the code. So when you download the Bitcoin software, in the code, it has the coding of this supply schedule, this difficulty adjustment rule, and your node is monitoring the network at all times for basically for new blocks.
Right.
And each block that each node downloads, right? Every 10 minutes on average, a new block is added to the blockchain. Each new block then goes through a verification process at every node level. And that's how we maintain the rule set and the supply rules all in one process, because they are not written down in a book that governs us or a law that governs us. They are coded into the software.
Right.
So everybody that has the software is upholding the rule set every single block. Your vote,
Right.
when you have a node and you download a block and you accept it into your chain of blocks, you are accepting that that block is valid based off of all the rules. Are all the rules followed in this block? And remember, because it's a computer and a software, it does it automatically for you. Your software
Right.
does it automatically for you instantly, as long as you are running code that you believe to be the correct implementation of Bitcoin. And that gets into the verification of software process, which is probably beyond the scope of this conversation, but verifying that your node is running the real Bitcoin software is an important thing for an economic participant in the network.
Right. Yeah. No, I wasn't suggesting when I said the rules weren't published. I wasn't suggesting that they didn't exist in terms of computer coding or protocol. What I was trying to infer was that they're not in a constitution or a document that you could go to the Library of Congress or the Bodleian Library in Oxford and look it up. I mean that doesn't exist, but it's obviously in the software. So the question is, who writes the software, and is there a way that maliciously that software could be changed, which would affect the integrity and maybe the confidence in Bitcoin?
Yes, so that's a great question. Who wrote the original code? Satoshi Nakamoto. Who is Satoshi Nakamoto? Again, it's a different conversation. So the fact that it came from an alias, and the original supply rules have not been tampered with to date. And by tampered with, I mean changed by the developers that run the protocol, that actually run the software and are using the software. So the users themselves. The supply rules, the difficulty adjustment rules were written by Satoshi Nakamoto. They haven't changed. Your second, and the fact that it's an alias is relevant. We can get into that more if you would like. Can the rules change? So if if a participant in the network wants to change some of the rules to Bitcoin. There are a couple ways that that person can go about doing it. One of the ways is to propose a change to the code publicly, share that change, and see if other people are willing to accept that change. So, generally speaking, people are not ready to suggest a change to 21 million or 10-minute blocks or difficulty adjustments, because those are the core rules that everyone follows. It would change the network. It would change the emotion of what this thing is by changing the supply rules. But maliciously, somebody could award a new block with a mining reward that exceeded the current 3 1/8 Bitcoin. Let's say I just award myself 100 Bitcoin in this next block, and I actually find an output that's below the target. It's a valid hash. I propagate that block to the network. Others will download it. They'll see the Coinbase transaction is 100 Bitcoin, not 3.125, and their software will reject it. Now, then take that to the next level of maliciousness. I find the block, but then I also launch thousands of nodes around the world, mining nodes and regular nodes, in different jurisdictions around the world, different IP addresses, through VPNs, and I started propagating the incorrect block or the invalid block. And basically, this is called a 51% attack, where the idea is that somebody can take over 51% of the computers of the network and extend the blockchain in a state of untruth. But it's the truth because it's 51%. So a 51% attack, which is, I think it's basically your question, was addressed in the white paper itself. So before the code, by Satoshi. Satoshi essentially said that as long as the network can stop 51% of the CPUs taking over, the blockchain will maintain its truth and maintain its rules. Because let me also introduce here another thing about what makes Bitcoin unique. We mentioned that there are several competitors to Bitcoin. One of the ideas early was, let's make the blocks faster. And another was, let's make the blocks bigger. So let's make them arrive more quickly so that we get an updated truth more frequently than 10 minutes on average. That was one idea. And another is, let's put more transaction in each block so that more people can get their truth through every 10 minutes. Both of those ideas have failed. And I'm going to explain to you a little bit about why the timing one is so important. Because if you speed up the blocks, you run the risk of the network being in a state of chaos, because many computers know many different things. And so a 51% attack becomes less likely at this 10-minute average block for some reason. Again, this is not my discovery, but the discovery of Satoshi and the people that ran the code in the coming years that toyed with the idea of how this network worked. And for some reason, this 10-minute average block, it worked perfectly in that essentially we never have disputes on what the rules are or what the state of the ledger is. And we do have the rare 2 blocks from different parts of the world happening at the same time. But then at the point of the next block being added to either of those 2 blocks, the conflict is resolved. Everyone just downloads the longest chain. And anybody who got their transaction into the block that they thought was going to be part of the blockchain, that transaction is no longer valid. You'll start over. For those 1,000 people, those, few economic participants that, fell victim to this random occurrence of a fork in the blockchain. And big deal, it gets resolved in the next 10 to 15 to 20 minutes anyway.
Right.
But the benefit here is that we don't have confusion. And the other side, your original question is about maliciousness. The opportunity for maliciousness with this slow and steady blockchain and node architecture, the opportunity for it is limited because the economic participants will reject your block if it's invalid. So I'll pause there, Michael.
Okay. This is in the realm of speculation, but let me just throw another stress test at this then. So what would happen? This is hypothetical, clearly. And let's think there is a malicious foreign government, and let's think of that possibly China. And China says that, it doesn't like Bitcoin, but it's going to make sure that within its domain, any computer that is running Bitcoin has to alter the protocol. So by there is, let's say, not 21 million coins in circulation, there are 25 million, and the extra 4 million is basically property of the PRC. Now, clearly they have a sizable footprint in computing power. It probably isn't anywhere near 51%. But hypothetically, are they able to control part of the network? And there would then be a division in terms of, let's say, Chinese Bitcoin and American Bitcoin.
Now, the last part of your question is interesting because they could definitely spin off their own asset.
Right.
And it would be its own network. But then that 25 million supply, all 25 million of those coins are in a separate network.
Right.
It doesn't mean that the 21 are in the current Bitcoin network. If they fork the network, it's a separate asset. And it won't trade as BTC on an exchange. It'll trade as BTC _ China because it's a different coin.
That's interesting. That's an interesting point. Yeah. Okay.
Because think about it like this. Currently, Michael, there's a let's call it a spat between BlackRock and Coinbase. Two mega participants on the institutional side of Bitcoin right now. We know that BlackRock has the largest ETF by AUM right now for Bitcoin. The ticker is IBIT. It set every ETF record this year for inflows. Shattered them, actually. And their custodian, IBIT's custodian, is Coinbase. So when we talked about those secret numbers, those private keys, the manager of the keys is Coinbase.
Mm-hmm.
The manager of the fund is BlackRock, in the same way that a hedge fund custodies bonds at State Street, but is the authorized signer, right, on the transactions, and actually instructs Salomon to send securities to State Street, right? And but State Street gets the bonds, not the hedge fund.
Right.
Because of legal. So it's set up like that for ETFs as well. Coinbase is the custodian here. Now, BlackRock wants to know that Coinbase is keeping the keys properly, right? Of course. Now, because it's a newer technology, Bitcoin, the proof of said storage is proving to be a little bit of a hurdle, especially because Coinbase is the custodian for many other, over a half dozen of the other ETFs as well. So there are worries about commingled funds, etc. Okay, that's the backdrop here. So BlackRock has their own ability to monitor the blockchain. Coinbase has their own ability to monitor the blockchain. They're each running nodes. They're each making sure that the Bitcoin managed by their apparatus is in the correct place. So they all have nodes. And the second they see a block that doesn't represent the rules that they all believe in, and it is a belief because anybody can change the rules of the next block, but who will download it?
Yeah.
Who will download it? And that's basically the rhetorical question to response to your proposal here is who will download it if you change the rules? If the People's Republic of China awards themselves new Bitcoin beyond the protocol, or even if they turn on the miners, basically the most that they can do is win the new Bitcoin,
Right.
because it would be fair play. Everyone would accept it because they found the hash first. They found the hash output less than the target that was valid, awarded themselves 3.125 Bitcoin, and only included transactions in the block that every other node found as valid too, because they all followed the rules of digital signatures, signing, balances that were previously allocated to individual private keys. Basically, Michael, when everyone has a ledger, if I download a node today, I have 15 years of Bitcoin transaction history on my computer now.
Mm-hmm.
So that when a new block comes down to me and I download it, and there's a transaction in there from some random user who's spending Bitcoin for the first time in 8 years, let's say, but I myself am able to verify that transaction is valid because it was signed by a private key that I can prove controls this address,
Mm-hmm.
which has this balance. So everybody is verifying. That's the decentralized node structure of Bitcoin. And now position Bitcoin now against its competitors. Have you ever heard of Solana?
Mm-hmm.
It's the third highest cryptocurrency by market cap that doesn't include stablecoins, essentially, that doesn't include stablecoins or exchange tokens like the failed FTX or the current BNB, Binance's token, which are not true cryptocurrencies. It's a different topic. They're pseudo equity, let's just say.
Right.
Solana has frequent, I should say, frequent, because these shouldn't happen at all, but they have frequent periods in which the network goes down, so you can't get a transaction through. Now, why is that the case? Because Solana is a company,
Mm-hmm.
and that the flow of data is dependent on a company. Why has Ethereum, the second highest cryptocurrency by market cap, experienced supply rule changes? The latest one was actually Ethereum shrinking its future supply, so making it more scarce going into the future.
Mm-hmm.
Do you think that made it more valuable relative to Bitcoin or less? You would think more because of scarce, but the price actually said less, and I'll tell you why. Because the market understood that, but if you can change the rules, it's not a decentralized protocol, it's a company.
Yeah. Which is where I'm leaning in terms of these questions. But I think, I mean, you're answering the question, which sort of comes back to this, um, you know, issue I raised right at the beginning, which is Gresham's law in monetary theory, which is basically saying, bad money drives out good. So you have a differentiation in quality between what look to be similar monies. So if the Chinese, for example, develop their own, or they partition the network, so they said, okay, there's a Chinese version of Bitcoin, which is only run on our systems, but we're going to give it the attraction whereby you could pay taxes to the PRC in Chinese Bitcoin, even though the protocol for supply has changed. that would then mean there were two Bitcoins in the system, as you said. But presumably the US one, I call it the US one, but the conventional one is one which is going to have higher quality. Qualities will be different and presumably have a higher value.
Absolutely. And there's a reason why Westerners don't use WeChat. It's not a network that is a universal network. It's a Chinese network.
Mm-hmm.
And so we have a unique country in China that is a global superpower with, almost a quarter of the world's population, a fifth of the world's population. So China, as it is central to your framework, has to be understood in Bitcoin's context. But
Mm-hmm.
we have a lot of experience with Chinese involvement in Bitcoin. An early miner, heavily involved in Bitcoin mining early on. There's still mining going on in China after the mining ban. We know that mining has returned to China in some ways. We also know that all of that Bitcoin that was earned by Chinese miners in the early days, some of that is still being held. We also know through this is a rabbit hole in and of itself, but Tether, the stable coin, originated out of basically the usage of Tether originated out of Hong Kong capital flight
Mm-hmm.
via Bitcoin mining, Tether, money laundry. And that is a big part of a pocket of Bitcoin's history,
Mm-hmm.
right? A pocket, as
Right.
just as the Silk Road, in the early days of Bitcoin being a currency for illicit activity on the internet, and the whole reason that the FBI seized Bitcoin in the first place, and that the U.S. government currently owns Bitcoin. So there are a lot of pockets of Bitcoin's history.
Right.
But back to China, we in the West are not using Chinese social networks because it's not where the world is.
Mm-hmm.
And so Bitcoin can be thought of in a similar way to the internet or social networks. The world is on the internet. The world is on social networks. The world is on Bitcoin. And China might and probably will try to do its own thing in many of the ways because it is a communist government. And it has a different way of doing things than the rest of the world. And that fact can coexist with Bitcoin becoming more and more like gold in its treatment, where you don't spend gold. You hoard it. You use it for reserve settlement. You use it for liquidity. If you need to derive cash quickly as a sovereign, you can do so if you have gold holdings. I say quickly,
Mm-hmm.
with a generous descriptor there. But go ahead,
Okay.
Michael. I'll pause for your questions.
Yeah, no, I've got some. I mean, I've got some questions which surround supply. They may not be appropriate now, but I mean, supply clearly is important because the demand for Bitcoin is really a function of this limited or restricted supply. I mean, that's what gives it its scarcity appeal. So, I mean, let me raise them now, and then you can see whether now is the right time to address them or not. I mean, one is, in fact, they both really pertain to the fact that Bitcoin recently has kind of traded sideways, to be generous, I suppose. And it certainly hasn't matched the recent performance of gold bullion. Looking at the last maybe 6 months, and what you've had through that time frame are interesting changes to the prospective supply of Bitcoin. I mean, one being this case, and I don't know to what I haven't really followed it exactly, but I do know it's existed, where the German government have actually dumped on the market holdings of Bitcoin that it had, that it basically had gathered through some sort of fraud, previous fraud investigation, and then basically intercepted that and then held it and then sold it back in the market. That's one. The other is really the rise of the ETFs, and to what extent does the existence of ETFs facilitate short selling of Bitcoin indirectly?
Both excellent questions. Let's start with Germany. A one-time event in which the German government dumps Bitcoin onto the market and the price held. And that's basically the only takeaway that we have to have as Bitcoin analysts. It is the most fascinating price to follow in the world. And I I've followed financial markets for over 20 years, and Bitcoin's price action, there's just nothing like it in the rest of the world. So when we see these huge moves, 10% swings in a day, it is completely within a couple standard deviations of history, making a a mini price dump off of the back of a German, sudden supply coming to the market, being absorbed with a price dump, but then bouncing, basically finding support, finding buyers in the market. It is it's a short-term victory for the market, and then the market moves on because it didn't cascade. All the cascading that can happen. Think of November 2022. We talked about gold. We talked about liquidity. Um, you know, the whole liquidity complex coming to a huge spike in bond volatility during that late 2022 era.
Mm-hmm.
And it coincided with stock market and Bitcoin weakness. The cascading, though, for Bitcoin in the headlines was all these hedge funds going under: 3AC, Voyager, Luna, Terra, and FTX, all these names that were associated with Bitcoin but weren't Bitcoin, companies with exposure to Bitcoin or on the outside of Bitcoin sphere, but affecting the whole asset class, bringing everything down, and all cascading really together. So the German situation, you just have to look at, did it cascade to this grand liquidation in which market confidence and the technicals were destroyed for the next 6 to 12 months or not? And it basically wasn't. I don't think it has. Bitcoin still trades in the mid 60s right now. Par for 6 months basically on Bitcoin with a lot of chop, but it's holding in well. And the ETFs, the short selling, it's a big concern, Michael. People are very concerned about shenanigans with paper Bitcoin in the same way that the games are played with gold, the gold price manipulation scheme that has been, uncovered through the London Bullion Association over the last decades, JP Morgan's involvement in gold's price suppression, lots of things uncovered about gold and price manipulation there. And so the concerns are valid, and I don't have a great answer to just say, hey, none of that's going to happen in Bitcoin, because we have heavy financialization of Bitcoin. And I just mentioned BlackRock basically knocking on Coinbase's door and saying, hey, we need a little bit better proof that you are not playing games.
Right.
And Bank of New York, no longer Mellon, I'm told. They've dropped that part of it, but Boney Mellon has now been granted an exception to custody Bitcoin by the US Senate. There are going to be competitors to Coinbase as the custodian for ETFs. So they're going to. So my point is that the BlackRock worries right now might be solved with some more competition, but it doesn't address paper shorting of ETFs that might limit price appreciation or suppress the Bitcoin price. A lot of Bitcoiners look to a tremendous industry veteran named Caitlin Long for her leadership on fighting the good fight on exposing Bitcoin paper price manipulation schemes, potential theoretical or real. We've had her on a couple times. She owns and runs a bank called Custodia Bank, which is in a fight with the Federal Reserve over Bitcoin custody and having a master account at the same time. And now looking at Bank of New York, Mellon being granted an exception and really saying, hey, you're picking sides. So that's something that we've covered a lot. Yeah. And it's a going concern, I'd say.
Yeah. But, counterparty risk among custodians is clearly something that could feed back negatively on the price of Bitcoin.
Without a doubt. And I think that with a global diversification of Bitcoin ownership, we will do better as an ecosystem to fight some of these concerns, because you have Bitcoin adhering to whether it's securities law, commodities law, or other property law in various jurisdictions should help best practices amongst global custodians. And this process is underway and has been for several years. Bitcoin exchange traded products in Canada and in Europe had a head start on all the Bitcoin ETFs in the United States. And the ETPs in Canada had a head start on property law and custodial relationships. And Fidelity had launched their if I'm not incorrect, Fidelity launched their Canadian product months before their US product. And Fidelity is the only US ETF that has their own custodian, which is their own basically branch of the headquartered Fidelity Digital Assets, which I'm sure you're aware of.
Yeah.
What are your thoughts here, Michael?
Well, I think you've answered a lot of those questions. I mean, that we can't really quantify the extent to which there is short selling, maybe of ETFs, and to what extent that has an effect on the Bitcoin price. But it must be there. Presumably, that's actually, that maybe is the wrong statement. I was going to say presumably that was an initial event, maybe caused by some skepticism about ETFs or Bitcoin that may go away in the future. I suppose it'll always be short selling. That's the reality, but it's not really going to materially affect the long-term supply or lack of supply of Bitcoin.
The way that I see it is the increase of financialization has a power over Bitcoin from the long side more than the short side, because a lot of what you teach, which is that a strong collateral base gives the financial sector the ability to create money. And the money creation itself drives asset prices.
Right.
And so if Bitcoin futures, Bitcoin ETFs, and options on Bitcoin ETFs are all live products, then anybody with access to leverage and a margin account can get involved to the long side. And in the ETF world, they do have to physically settle, despite whatever games might be played or are attempted to be played. This is happening all around the world, where the physical settlement of Bitcoin, and when I say physical, I mean the coins sent to an address, that transaction included in a valid block, downloaded by the entire network, and basically becomes past history. And each block that passes, remember we talked about forks. A block right now should, all exchanges that are doing their due diligence and proper best practices, they wait 3 to 6 blocks until they let you sell. If you send, they wait, and then they'll say, oh, enough blocks have passed. Your funds are valid to trade. Your Bitcoin is valid to trade.
Right.
But once an hour has passed, that's now, hammered into stone. And it's not even stone. It is permanence, because it's digital permanence on every node in the world.
Right. Right. I think I think these are really interesting questions because, as you rightly say, collateral in the international monetary system is really important. History shows, and I'm talking here of long-term history, that the most important price in financial markets is always the price of the dominant economy's debt. So, in the 19th century, it was British consols. Now it's U.S. treasuries. But in a multipolar world where government debt, the integrity of government debt must be questioned because of increasing monetization, you're then going to gravitate towards a new form of collateral, and maybe that collateral is Bitcoin. So maybe that is the future collateral that we've got to be thinking about, because it does have integrity, as we've been arguing,
It
and hopefully
is
prove.
it is pristine collateral from so many qualitative angles. Because if you think about testing the purity of Bitcoin, testing the purity of gold, and testing the purity of US treasuries, they all have pros and cons, but testing the purity of Bitcoin is the most transparent of all three of those assets by such a wide margin. You mentioned the increasing monetization of US treasuries, increasing monetization and supply, and no limit in the increase in supply. All of those things happen. Gold answers some of the increase in supply, but it is a logistical nightmare to move the metal and to actually test it all.
Yeah.
Right?
Yeah.
When we think about the differences between Bitcoin and gold when it comes to verification of that process. And so in the digital world that we live in, Bitcoin represents the most pristine collateral that you can imagine, because it's not tied to a government. So it doesn't have those risks, and it's not tied to something physical. It's numerical, which can be transmitted via computers and can still
Right.
act as physical because the numbers themselves are rare.
Right. 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 Understood. Yeah. I mean, if you take another example, um, Bitcoin has a ceiling on 21 million supply, as we've been discussing. The US debt, US government debt, has a debt ceiling. There's no debt ceiling at the moment. It's going to be reimposed January 2nd, 2025. But then we know that debt ceiling is going to ratchet higher and higher over the years. Because the supply of US debt is not fixed, despite the notional debt ceiling. That debt ceiling is a floating ceiling that only floats upwards. But if you look at the data since year 2000, the outstanding stock of US debt, which is in the sort of, what is it, 36, 37 trillion right now, has increased by eightfold. There are very few assets that have gone up 8 times over that period, but gold is one. And I would venture, obviously, Bitcoin, but that's an unfair association, is another one.
Yes, the supply of US treasuries won't come down because that's a political phenomenon.
Right, right.
And we have a lot of evidence that the way out of that type of debt load is
Hmm.
not going to be a contraction of it and a physical pay down,
Hmm.
right, through the liquidation
Right.
of assets. Michael, I want to go to slide 37 because we are talking about the limits of supply. So I want to show you a little graphic here which details the supply function, the programmatic unfolding of that supply for Bitcoin. And to just give you, an idea of the certainty that we have. Now, this little table here, it only goes out 36 years into the future, whereas Bitcoin's supply schedule is scheduled to continue to increase until the year 2140. So in 116 years from now. But you can look at the 2024 line, which is era 5. We've gone through 4 halvings. The last one was at block 840,000, as you can see there. And at block 840,000, we had reached 19,687,500 Bitcoin.
Right.
And 96%, 96+% of the Bitcoin to ever be created. And so what that basically means is that the new Bitcoin coming into existence now are such a small fraction of the existing Bitcoin that the fight over those additional Bitcoin becomes so fierce. And that is itself baked into this mining process. So there's really this virtuous cycle in Bitcoin in which the network started to gain value, which attracted miners to the network so that miners could win the reward and sell it for profit. But the increased miners increased the difficulty. And the increased difficulty prevented what? It prevented the threat of 51% attacks, which was one of your first questions here. What about the maliciousness? Well, the more miners that you have in more pockets of the world, the less likely there is to be a 51% attack. And if that is less likely, what becomes more valuable? The underlying coin itself.
Right.
Because it has more security, more decentralization, and then that attracts a higher price, which attracts more miners.
Right.
And you do cycle up and down with Bitcoin. You can look at slide 40 here. Slide 40 is an unbelievably informative representation of Bitcoin and its history. This is a concept called HODL waves. HODL being the word hold, misspelled per the Bitcoin meme culture, and waves because Bitcoin, as it cycles, experiences waves of old coins being sold. So think about it like this. If you were an early adopter and you mined Bitcoin when you had your laptop on, and remember I mentioned that Satoshi said CPUs, as long as 51% of CPUs aren't malicious, that was when you could mine Bitcoin on your laptop. But CPUs can't get the job done anymore. They just can't compete. That's why we have specialized hardware for Bitcoin mining now. If you were an original miner of Bitcoin and you saw Bitcoin spike to $1,000 in late 2013, and you were sitting on $500,000 worth of Bitcoin from something that you thought was worth zero when you did it, or basically something that was worth maybe, one pizza is now worth one house. You're likely to see, or you're more likely to see, a liquidation in that type of parabolic price move from those original holders. And so then what you see in these colors are waves of activity in which the age of coins shrinks. And by age, I mean how long had it been since those coins moved on the blockchain?
Right.
Because if I'm holding and I send it to the exchange getting ready to sell, the coin has now moved. It has a new age. That age is 0, as opposed to that age being 2 years or 3 years. So with the age of coins moving through the system, we're able to measure something behaviorally so interesting. Imagine being able to watch the age of shares of individual stocks being traded hands. We would derive information from that.
So this is really a measure of the velocity of Bitcoin.
In a way, yes. Velocity traditionally, right, is going to be based off of the number of transactions
Yeah. Well,
and
this is
this
the turnover.
and the size. This is the number of transactions aren't changing, but what is changing is the age of those underlying units that are moving.
Right. So in fixed income speak, basically you're moving from off the run to on the run. More and more of the coins are on the run.
That's a wonderful way to put it. When coins leave the off the run and become on the run, so in fixed income terms, if you're a corporate and you do a fresh issue and then you do a buyback or a call of everything that's outstanding, that's near maturity, a cleanup call basically. That type of activity is it takes place during Bitcoin's parabolic moves,
Mm-hmm.
where you see a whole flurry of activity of coins that haven't moved in a long time. And then in the interim periods, we see holding, or as Bitcoiners call it, hodling. They hodl and hodl and hodl because they understand behaviorally that at some point there will be a squeeze on available supply if they create it themselves by not sending coins to the exchange. Because in a parabolic move, you get retail, they come in, they buy, and the authorized participants go to source, and the coins are running out. The price shoots up. And then how does the
Right.
price come back down? The long-term hodlers send their coins to the exchange, and they liquidate at these very expensive valuations. And why are they expensive? Because they're relative to the on-chain cost basis of those original holders, which in Bitcoin speak is called realized price or the realized value. It is it's basically a sum of an aggregated sum of coins that have moved and their US dollar price.
Right.
Coins when they have last moved, apologies. Coins when they have last moved and the dollar price at which they last moved. So when we overlay Bitcoin's price to its realized price, we can say that realized price goes in a very steady stepwise function, but price obviously chops around all over the place. And when price falls below realized price, it never stays there for an extended period of time, as that's basically the network at trading at a loss or holding at a loss. And the general growth path of Bitcoin brings, the staunchest believers back into the market, and they
Right.
buy below realized price because they
So
see
it's a
value.
measure of marginal supply.
Yes.
Okay.
It does measure marginal supply because the age itself, the relative price to realized price, measures the profitability.
Mm-hmm.
And profitability will motivate marginal
Sure.
supply. Absolutely correct. I've never described it like that, but the MVRV ratio, which is our market price to realized price ratio, represents our best Bitcoin valuation metric that we have, because it represents the willingness to sell because of profitability. And that willingness to sell due to profitability will directly inform marginal supply.
Right. Got it.
Now, Michael, I want to guide you through here on slide 50, if you'll jump ahead for me. We didn't get into every bit of the cryptographic details here, and I'm not sure that we needed to, but I'm happy to, continue going over this when we meet again for part 4 here. But I want to guide you through the lifestyle of the life cycle of a Bitcoin transaction here, so that you can follow a transaction from origination to blockchain and see if you are following the mining process and the transaction process as one process, because they are.
Right.
Okay? So I send you Bitcoin. So I have a wallet open and I sign a transaction, meaning I authorize every node in the world. I authorize every node to take this balance that was once mine and sign it over to a new address that you've created for me, that you generated yourself, that I don't know. And remember, you hashed it and hashed it again to give me the address so you could share a piece of information with me. But you, and only you, have the private key, so that if you want to spend it one day, only you can.
Right.
Okay? So I sign this transaction, and it goes through multiple steps before being added to the blockchain. Okay? So I broadcast that transaction to the entire Bitcoin network. It's not part of the blockchain yet. It goes into a suspense account, to use a financial term. It's called the mempool. Miners then aggregate new transactions together into a block, and they look at the mempool and grab transactions. Now, I will also have attached a small fee, which is denominated in Bitcoin, a fraction of a Bitcoin. I will attach a small fee to my transaction as a signal to miners, hey, please include my transaction in your block. Because if you win the block, you'll get to keep the tail.
Right.
Okay?
And that's a fixed percentage.
No, it is not fixed, it's variable, and it is completely up to the sender.
Right.
So the sender can assign priority with a price signal. Low priority, low fee. High priority, high fee. Next block urgency, high fee. Not next block urgency, can wait a few blocks, fall to the bottom of the line, low fee.
Right.
So
but there are conventions here.
There are conventions, there are wallet conventions. Each wallet provider will have its own convention. There are conventions. But again, these are things, Michael, that are in the sphere of BIPs, these improvement proposals. People working on all sorts of improvements, like how to attach miner fees. One of them was, hey, if I attach a fee and I realize that it's too low and it's going to take me a day, I want to bump the fee up, but I don't want to cancel my transaction. That takes technical workthroughs and coding. They're working on all of these things. And by they, I mean Bitcoin developers that do not work for a single company, that are more or less decentralized, might be funded by a few companies, might be funded by open funding, or might not be funded at all, and are all working together. And then nobody is saying yes or no. They propose and then mass accept or mass reject, as a consensus. And even that has disputes. I'd love to get into the 2017 dispute with you at some point if we could, because there's a lot of history to unpack there. So number 3, Once the miners have aggregated their new transactions, then they start to find a proof of work. And that's the hashing.
Mm-hmm.
Right? So performing the function. When proof of work is found, it means that the output of their hashed block is less than the target, which is rare. It's very rare. So when they do that, they broadcast the block to the network. Then the network participants see the block, they download it, and then they check, are the transactions valid? Is the Coinbase transaction valid? Did it come from the most recent block that I also know? So did it include a hash of my most recent block so that I know it's using the current state? All of that is done automatically. Then miners acknowledge the block as valid by moving to work to the next block. So not just the economic participants, but the miners too, they all download a valid block, and then they see, oh, this is correct. Okay, I'm going to start over, and now I'm going to use this new block as my previous block hash, and I'm going to start assembling a new block.
Right.
And that's how Bitcoin transactions are added to the Bitcoin blockchain. And it's also how new Bitcoin comes into supply, because in each block, there is a Coinbase transaction which awards new Bitcoin to the miner per an exact supply schedule that is following its timing. Basically, in that every 10 minutes, we get a new block, and every 4 years on average, and it's 210,000 blocks, not 4 years, that every 210,000 blocks, the mining reward, the Coinbase transaction, will half in its quantity of Bitcoin awarded to each miner. And so the supply, the programmatic supply is held, it's upheld every 10 minutes. It's upheld every block. Right. Even though the halvings happen every 210,000 blocks, right, the rules are followed every block, because every block represents the rules.
So once you get to 21 million coins, miners can still make money because they're validating transactions. And they're clipping each time you get a transaction with a small amount of Bitcoin. They're getting paid out of the existing pool.
Absolutely correct.
Right. Got it.
It's funny how many people think that Bitcoin running out of new supply in 2140 will all of a sudden just eliminate miner incentives, but that's not the case. If we stopped finding gold in the Earth's crust, would we stop using gold, or would it still be valuable?
Yeah. Well, the answer is obviously more valuable, but there we are.
The answer is obviously more valuable. Michael, any last questions here? We've gone.
No, I think I've got it. I think that's it's becoming more and more clear. I think this whole this whole episode, this whole journey. So that's great.
Okay, excellent. Well, I'm going to design an excellent part 4 for you to go more into the financial side. We'll talk about realized price, our MVRV, and I want to know your questions about Bitcoin's valuation, where you think Bitcoin finds a role in our monetary future, and how it compares to gold, all of that. So we look forward to our next meeting.
Yeah. And I think some of the metrics that you use as a Bitcoin analyst would be useful to understand more fully. Which are the key metrics?
Absolutely, we will do that. We'll start with realized price, and we'll go from there.
Brilliant. Look forward to it, Nick. Thank you.
With Michael Howell, I'm Nick Bhatia. We'll catch you guys next time here at the Bitcoin Layer.